Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and in this video, we're going to be talking about how to determine exactly what investing strategy you should take, whether you should invest in bonds, whether you should invest in, the highest growth potential, super risky companies, whether you should keep your money in index funds, or how exactly to figure out what strategy is right for you, and how exactly I sort of came to the conclusion of what strategy is right for me and kind of what my strategy is. So at least in the context of this video, in order to sort of take a systematic approach to this, we're going to be using 5 criteria to sort of shape our investing strategies. And I have to definitely give a shout out to Matt Money. He has a great YouTube page. I'll leave a link to that. But I first saw these on his Twitter account. He had them posted there, and I'm not sure exactly if he came up with them. I think he did, but I'm not positive. I don't want to give him credit if it was someone else, for example, but I definitely saw it on his page, so he deserves the credit, it seems, in my opinion. But basically, these 5 criteria are: what are your objective, time horizon, risk tolerance, time commitment, and continued capital contribution. So we're going to go through all of those and talk about them a little bit, and then they talk about how they apply to my situation. So the first of these criteria is objective. So what is your objective for wanting to invest some of your money? Is it just to preserve the wealth that you've already built, or is it more to, build that wealth and get that ball rolling? So for someone that maybe just wants to preserve whatever wealth they have and not really lose any of it, then it might be better to go with some index funds or maybe even bonds or something like that. It really just depends. But maybe if someone's trying to grow their accounts super rapidly and are willing to take on that risk, then maybe they could invest in some more speculative companies that haven't proven themselves, but could potentially yield some pretty fantastic returns. So that's just the first thing to look at there. And then the next one is time horizon. And that is basically just taking a look at, when am I going to need this money that I'm going to be investing? So it might be a few years, but I think ideally for most people, investing works best when you have many years, 10, 20, 30 years, because then you really don't need to worry about the short-term market or the short-term fluctuation in certain companies. Some of the sectors are kind of cyclical in nature, and they just go through these cycles along with the economy. And so, if you just buy at the wrong time and then you need to get out a few years later, and that just happens to be at the wrong time, you could be kind of screwed. Where if you have a lot longer time horizon, that is much better. And another thing to consider with time horizon is, if you don't have that long of a time horizon, that's okay. There are still investing strategies that will work for you, but that's just something you have to consider, and something you need to take a look at to say, well, maybe if I do have a shorter time horizon, I need to consider the fact that investing probably for the long term isn't going to be super beneficial. If I only have a few years, I need to look at some different strategies of how I can take advantage of the market and take advantage of these companies to make some money. And the next criteria being risk tolerance. This one is obviously super important, and probably the one that people talk about the most. And it's sort of tied in with the others too, because if you have a super high risk tolerance, then you're probably not wanting to preserve your wealth, right? If you're wanting to preserve your wealth, you probably have a low risk tolerance. So some of these kind of tie together. And so kind of like I was saying earlier, if you have a high risk tolerance, investing in some of those more speculative companies that you think have good potential in the future could be something that you would want to consider. But if you have a very low risk tolerance, then it might be better to invest in, old blue chip companies that have a super great track record, or even, index funds and bonds. The next criteria is time commitment. And I think this is one of probably the most underlooked of these criteria, or at least I think it's much more important than a lot of people make it out to be, because you can spend a lot of time doing lots of research into all this stuff and learning a whole ton, or you can not spend much time at all. So it really depends what you, first of all, want to contribute and what you're willing to contribute, and then second of all, it depends on what you're able to contribute. So that's really dependent on a personal level. Some people just don't have the time to be in the market during the day. They have a job that's on a super tight schedule, or they're just busy or whatever, so they can't really be in the market. So they just can only buy for the long term, and they just buy whenever they have money, and they're pretty hands off, and that's totally fine. But if you do want to put a lot more time into it, you can probably do pretty well as well. And this is one of the super interesting things to me, is it seems if you're able to put more time in, it almost lowers your risk. Because, for example, if you're looking at investing in some more speculative investments, well, if you're able to put in a lot more time into that investment, you might be able to come across some research. Maybe you're looking at 10 companies, and if you put in 1 hour, well, you might say, well, about 5 of these companies I like, and so I'm going to invest a fifth of my money in all these companies. Whereas if you put in 10 hours of research, you might have come to the conclusion that only really 2 companies you liked, and the other ones weren't so good, or maybe they just weren't at a good price that you liked at this time, and so maybe you just decided to put your money into those 2 companies. So in theory, that could be more risk because your money is more concentrated, but it could also be less risk because you're also much more educated on your investment decision. So I think that is definitely something interesting to consider. I would say investing has definitely taken more of my time than I anticipated it would have. I'm certainly have the time and am willing to put that time towards it, but it definitely was not expected. At least I did not expect it to take as much time for me as it does. And then the last criteria is just continued capital contributions. And this is super important to just realize and think about a little bit how much money you're going to be able to add to the portfolio, and how often you're going to be able to do that. Because if you can add money every single week, well, then you might not really worry about keeping any cash in your account. You can just pretty much deploy it as soon as you get it there, and then next week you'll have that cash. And if there's a good opportunity, you'll pretty much always have some cash there to deploy at said specific opportunity. But if you can really only deploy any cash to your account maybe every 6 months, then you might need to portion that cash out over time and deploy it a little bit over time, so that if you do see a good opportunity, then you can jump on that and still have cash left to invest. Or maybe you just want to hold your cash completely until you see a good opportunity. So that's really something you want to look into a little bit, and it sort of gets into the question of how much cash you should hold. And I think considering how much capital you can add at what time intervals can help you determine how much cash you should hold. And just to give you some specific context, I'm going to talk about my strategy and sort of my answers to these questions here. So for the objective, my objective is simply to build wealth over time and become financially independent, if you may call it. And I hope to do that probably at a much younger age than most people in this country. So that's what I want to do. And that sort of ties into my time horizon, which I would say at a minimum of when I want to sort of use some of this money would probably be anywhere between 15 and 30 years. Obviously, if I have money in Roth IRAs and 401ks and stuff like that, then that time horizon is going to be at a minimum about 40 years from now. But at least for whatever other investments I have, I would say 15 to 30 years is probably the minimum amount that I would consider taking any money out of there, unless some major life event happened, but hopefully I don't have to do that. As for my risk tolerance, I really think it's kind of in the middle. I do some slightly more risky things with some of my investment money, but at the same time, a lot of my investments are in what I would consider pretty safe investments that do not have much risk associated with them for the most part. I do think my risk tolerance is probably a bit lower than most people my age, because people say, well, you can take a lot of risks as a young person, but I definitely sort of see that. But at the same time, I am much less educated with investing than probably a lot of people. I certainly have a few years of experience. I feel like I generally know what I'm doing, but there's definitely always more to learn. And so at this point, I feel like having my risk tolerance a bit lower is just what I want to do. So that's what I'm doing. As for the time commitment, I'm definitely able to spend a little bit of time a day, maybe like an hour in total, to look at my investments and maybe add to some of them here and there, or things like that. But I'm definitely not out there day trading all day. I do have a full-time job during the summer right now, so it's a little bit more difficult now that I have that restriction of being at that job. But I am able to still put in some time and still do research outside of market hours. So that's something for me where having a simpler strategy is also better for that time commitment part, because you don't have to spend all your time worrying about the market. And for my additional contributions, I would say I'm definitely not contributing as much as I would like, just because I'm still in college and I'm not making a whole lot of money. So generally, I have been proportioning out my money to invest, every week or every month, and just kind of keeping that at a small amount that I know I'll be able to do. And then during the summer, since I'm working, I'm definitely going to be investing a little bit more than normal. But overall, I would say I definitely plan to contribute a lot more in the future. So I'm just gonna keep adding money over time and keep building that portfolio. So based off those general 5 criteria, my investing strategy is basically to just invest the majority of my capital in low-cost index funds. And my 2 favorite ones that I invest in are VOO, which is a S&P 500 index fund, and then I also have some capital in VTI, which is a total stock market index fund in the US. So basically, the purpose of this is just to match the performance of the market and get some good returns while being super simple and low cost index funds. So that's why I have those. And then I do invest the rest of my capital in some little bit more risky things. So I have some money in dividend stocks, which are definitely not as risky, but I am picking individual stocks, so that's a bit more risky. And then I definitely have a little bit of my money in some riskier stocks that are just less established companies and do not have a super great track record behind them to show that they will be able to continue performing strong into the future. I certainly have a belief that they will continue to perform strongly in the future. That's why I invested in them. But I mean, there's definitely nothing guaranteed with an investment, but these are just a bit more risky, and I'm willing to take that risk because it is a fairly small percentage of my portfolio. And then I also do have some cryptocurrencies that I hold. I've talked about that in a previous video, but those are definitely risky. The crypto market has been tanking recently, so that's been interesting to see. But I have been considering picking up some more cryptocurrency just because of the cheaper prices now than they were a month or 2 ago. And then finally, I do some options trading, which is arguably the most risky thing I do. One could argue it's cryptocurrencies, but with the options trading, I'm mostly just selling options, which is probably the safer side of options trading. But I have been spending a lot of time, probably over the past 6 months, getting educated about that. So like I said earlier, I feel like that education has lowered the risk a little bit for me and has allowed me to be more comfortable with what I'm doing there. And the purpose of these, smaller investments in these different kinds of things are just to, diversify a little bit what I'm investing in, and then use those ancillary holdings sort of to boost my returns a little bit and try to beat the market in the long term with those other investments. When I first started investing, I definitely did not think about my strategy really and consider some of these criteria. So I would definitely recommend that you guys, if you have not, just sit down and think about these things for a little bit. And you don't have to change your whole mindset or your whole strategy or portfolio of what you're doing, but just use them to kind of give you sort of a guideline for how you want to invest and what you feel comfortable with and things like that. Just to give you somewhat of a more structured view of your portfolio and your goals moving forward, because I think it's super important to have some sort of guideline or path that you're following in order to reach your goals in the end. So let me know how you guys have come up with your investing strategies or what has shaped your decisions of how to build your portfolios. I think that kind of stuff is pretty interesting because I could certainly always use advice or suggestions like that. So I would definitely appreciate any comments down below. And I did a video about a month or 2 ago on the book The Simple Path to Wealth, which talks about a lot about these ideas about what investing strategy is right for you. So I'll leave a link to that right up here if you guys want to check it out. I think that would be a great video for you guys to watch, and I will see you in the next one.